Price can either do three things: move up, move down, or move in sideways. The market is always in flux, and price is always going somewhere. Without the proper knowledge and understanding of these structural movements, you as a trader will often trade opposite in the direction of the market. Whenever you do this, your winning rates will be reduced drastically, leading to countless losses in your trading activities. So, in this tutorial, I'll educate you on everything you need to know about trading market structure as a professional trader. I'll walk you through the basics to the advanced level so that you can effectively apply the knowledge of the market structure to trade the right way in any market of interest. Ensure you subscribe to Path of Greatness if you'd like to see more trading tutorials. Alright, with that said and done, let's get the learning started. So, what exactly is market structure? As the name implies, market structure explains the structural path or direction of movement the market undergoes to achieve its objectives. Three trends can exist in the market structure of technical analysis that we need to be able to identify as a trader in any given market. There's an uptrend market structure, sideways or consolidation market structure, and the downtrend market structure. What is an uptrend market structure? We need to view an uptrend market structure as the staircase for ascending to the floors of a building. Therefore, whenever the price ascends upward, such a trend is referred to as an uptrend or bullish market structure. In this type of market structure, we should be looking for possible buy entry because the market structure favors buyers as it ascends upward. Whereas a downtrend market structure is the opposite of an uptrend market structure. This time around, you view it as when you descend from the floor of a building through the staircase. In the downtrend market structure, traders should be interested in possible sell entry. Now, what is a consolidation market structure? A consolidation market structure is a market trend trading within the range. In this type of market, the movement of highs and lows is usually in equidistance zones. You need to view this price range medium as the floor of a building. This technically means the market lacks clarity, and we shouldn't be involved in such a market as a beginner trader unless you have an effective trading system that allows you to utilize obvious market liquidity within that particular range. As a beginner trader, you should ignore such market structures whenever they appear in the market. It's easy and safer to ride a trending upswing or downswing market structure. If I were a beginning trader, I would just focus on trading in the direction of the trending market structure because that's where the big players in the market are mostly active due to its high probability factor. It's time we go deeper into how each market structure we've discussed is formed in the market. To make the correct judgmental view of the market trend, we need to know the right side of the market to be active. We need to carefully study the highs and lows printed in the market trend of the asset we try to analyze or trade. First, let's start with the uptrend market structure footprint. For a market trend to be regarded as an uptrend market, the market price trend needs to repeat higher highs and higher lows. That is a new high which is higher than the previous high at the top zones, and a new low which is higher than the previous low at the bottom zones. Therefore, if the market is in a repetition of higher highs and higher lows, we know the market is in an uptrend, and you, as a trader, should only be interested in buying until the previous higher low has been voided in the uptrend. In a downtrend, the market swing is opposite to the uptrend market. A downtrend has highs and lows swings turning to lower swings in the market. A downtrend market structure is a market repeating lower lows and lower highs as the trend progresses downward. The next low will be lower than the previous low, and the new high formed will be lower than the previous high. A sideway or ranging market structure is a price trend at an equilibrium or consolidation phase. It means both the buyers and sellers are moving the prices at the same equidistance level, resulting in a bound market movement without clarity. The sideways market will form equal lows at the bottom and equal highs at the top. At times, it could be an irregular lower low swing, followed by a higher low or higher high, followed by lower high. In this type of irregular market, the trend is regarded in a state of confusion, and it will be difficult for you as a trader to analyze the market trend. This makes it a market trend you have to ignore and wait till when the market is defined before looking for possible trade opportunities. Now that we know that the only two market structures easy to trade are an uptrend and downtrend market, that doesn't mean you as a trader should buy at any point in an uptrend or sell at any point in a downtrend. Let me show you why you shouldn't buy or sell at any point in a trending market. In a trending market, there are two types of price movements. 1. The price movement in the direction of the trending market. This is called an impulsive move. In an uptrend, the rising price movement is called the impulsive movement, whereas in a downtrend, the falling price movement is called the impulsive movement. 2. The price movement opposite in the direction of the trending market. It is called the corrective move. In an uptrend, the falling price movement is called the corrective movement, whereas in a downtrend, the rising price movement is called the corrective movement. Let's delve deeper into an impulsive and corrective move. As we already know, a trending market structure consists of two different moves. The impulsive price swing is the main move of the trend. These moves tend to extend stronger and larger because it's where the major players in the market are active. A corrective move trend is weaker and shorter because it is a movement against the trend or a movement fighting the market trend and is dominated by the minority of the market. Here we're on the day chart of NQ futures. From the left side of the chart, the market starts in a downtrend. Price formed lower highs and lower lows consecutively as the trend progressed down. The impulsive movements are forming new lower lows. These impulsive moves are stronger and have a larger distance. This contributed to the fast falling flow of the market. The corrective rising price move is the result of profit taking by major trend players in the downtrend. The small bullish pullbacks are also called counter-trend price swings because they counter the direction of the downtrend market structure. Of course, there has to be a period of exhaustion in a trend. We shouldn't expect the price to continue in a straight line. There has to be a medium of profit-taking resulting in small pullbacks and could result in a consolidation phase if it is in excess within the price action, which makes it more difficult to be traded. You will struggle to make money trading in this type of market structure because the probability ratio is low. Just as I stated, sellers will take some or total profits in the downtrend, and this would trigger buying opportunities for buyers. However, that doesn't mean you should be buying because the buy entry winning probability is low, since the buyers move the market against the direction of the impulse wave. The corrective bull price swing will get exhausted until it reaches a new level where new sellers are interested in selling the continuation of the downtrend market structure. Once the selling zone has been identified by sellers, sellers will load more selling orders that supersede the corrective buying order. The new selling order will then trigger the resumption of the impulsive downtrend because the sellers have more selling power than the buyer side in the trend. The sellers will then move the market to a new low. That is a low lower. So that's what brings about a downtrend market structure. Now what you have to do when you're trading in a downtrend market structure is to grab the impulse moves by selling from the top of the bullish corrective moves. The downtrend will have an end at a certain point, and the market has to be reversed in the opposite direction of the downtrend. A sharp U-turn may reverse the downtrend, or a consolidation reversal could occur. In this downtrend, the reversal came after a sideways market. After the buyers broke the upper section of the sideways market, the market progressed higher, and that was the first early signal of a downtrend breakout. Before we discuss the uptrend market structure, let's study the sideways market structure that put an end to the downtrend on the left side of this price chart. After the price got to a certain low swing as a result of selling activity, as usual, more sellers began taking profits, and this interested buyers to start looking for some buy at the low structure. At the high, the sellers put in more selling orders, and the price moved lower but failed to go lower than the previous low. This action indicated a balance between the sellers and the buyers. The market kept repeating balance in motion, and not until the buyers eventually defeated the sellers out of the sideways market structure. Also, if the market had broken to the downside, it would have indicated a possible downtrend continuation. Technically, whenever price results in a randing or sideways market, the result of the breakout could be to the upside or downside. The overall trend is still bearish because we have yet to see the price transform into an uptrend market structure. Why is the market yet in an uptrend market structure? The market is yet in an uptrend and not until the market validated higher high and higher low price trend swing. The sellers pushed the price down, and this time around, the buyers set in to defend the trend, thereby leading to the formation of a boundary line called the first higher low swing in the downtrend. Later on, the price trend kept printing more higher high and higher low swings, indicating the market had switched from the seller's hand to the buyer's custody. If you were a seller in this market, it's an indication it's time to terminate your downtrend bias and start watching for possible right zones for buying entries. Remember, the market will not always move in a linear structure, but instead in a wavy pattern. The small selling swings in the new uptrend are the countertrend or corrective move in this new uptrend market structure. The larger uptrend swing is the impulsive move, and this is the type of price swing you should be interested in trading in an uptrend market structure. You would have noticed on this price chart of NQ futures that it is not the first time the trend seems about to change to an uptrend, but it later continued the downtrend. Not all changes in market structure are real. The majority are faked or engineered to trick inexperienced traders. Your role as a trader is to identify where the reversal is about to happen when it has occurred and before it has moved too far through the combination of other factors. In the next chapter, I'll show you other factors to combine to detect real and fake switches in market structure. Ensure you subscribe to Path of Greatness if you would like to see the tutorial.